Welcome to the IADS Retail Park. I'm your host, Maya Senko. Today I'm joined by Anchita Ranka, who heads analysis and perspectives here at IADS and wrote this week's exclusive on David Bavarez's presentation at our 66th General Assembly in Hong Kong. Anchita, thanks for being here.
Thanks, Maya. It's good to talk through it. The article captures the main arguments, but there's a lot of texture that gets compressed.
Let's start with the setting. Hong Kong, specifically. David's based there, and he makes this comparison to Vienna during the Cold War, neutral ground for two powers that can't officially meet. What's the practical reality behind that?
You have a $600 billion trade relationship between the US and China that doesn't stop existing just because the political relationship is deteriorating. Both sides still need somewhere CEOs can meet, negotiate, and maintain relationships without the legal or political exposure they'd face in each other's capitals. Hong Kong fills that role. It's not symbolic, it's functional. The conversations keeping that trade alive are happening there right now.
So you have this enormous economic engine running in parallel to the political confrontation, two completely different registers.
And David would say understanding that gap is essential. The headlines push a decoupling narrative, and there is real decoupling happening. But there's also a $600 billion reason to keep channels open. You can't read either one without the other.
And this brings us to the central argument, an economy of war. That's not a cautious phrase. What does he actually mean by it?
He's marking a structural break. 30 years of globalization, 1989 to 2020, ran on consumer-led logic. Markets signaled, companies produced, demand pulled supply. What he's describing now inverts that. Supply control sets the tempo, not consumer demand. For retailers, what used to follow from understanding what customers want, margins, availability, lead times, those now follow from your relationship with the supplier. The leverage has moved.
And the COVID period made that visible. China went from 30 to 35% of global manufacturing while everyone else was contracting.
It wasn't incidental. It was a consolidation of a dominant position at a moment when the rest of the world was disrupted. Retailers who'd built heavily on Chinese sourcing had that dependency exposed in a way that hadn't been visible before. The concentration was always there. COVID just made it impossible to miss.
He also identifies October 3rd, 2025 as a specific turning point. The Kim Jong-un visit, the Russia energy deal, rejecting NVIDIA chips even at a 50% premium. Is he reading a pattern or a coincidence of timing?
A deliberate pattern. Each of those moves has a signal dimension beyond the economics. Refusing NVIDIA chips at a premium tells you the decision isn't about price. It's about demonstrating that China is building its own capacity and doesn't need to accept terms it didn't set. And it connects to the rare earths point. US rare earth imports from China are only about $200 million annually, small in absolute terms. But China controls segments of global supply chains that most Western companies haven't mapped properly, and the signal is that access can be withdrawn.
The overlooked corners of the supply chain become the actual pressure points.
Exactly, Maya. And most risk assessments focus on the obvious concentrations. The low-tech, low-cost segments, that's where the leverage actually sits.
I want to stay on the innovation question because it challenged my assumptions. After 2022, the consensus view was that more state control would mean less innovation. The data doesn't support that.
It really doesn't, and David is quite pointed about this. In 2024, China accounted for more than 30% of all new molecule discoveries globally, over $40 billion in licensed drug deals, significant advances in green tech, automation, robotics, pharmaceuticals. The funding mechanism is decentralized public financing rather than private equity, but local autonomy in capital allocation is still present. So innovation continues. What breaks is the link between innovation and productivity.
Can you say more about that? The distinction matters.
Yeah, of course. In a Western economy, innovation typically drives productivity. You do more with the same inputs or the same with fewer. In China's current model, the government reinvests innovation gains into expanded hiring and manufacturing capacity, often at a deliberate loss. Employment stays high, output stays high, capital efficiency is low. For retailers or manufacturers competing with Chinese producers, that's genuinely uncomfortable. You can't out efficiency a model that isn't optimizing for efficiency.
And the strategic goal isn't efficiency, it's dependency. The 5 year plan reaffirms self sufficiency at home and maximum reliance from other countries.
That's explicit. The rare earths, the supply chain embeddedness, the export pricing that undercuts Western competition, it all connects to that. Exports stop being a growth engine and become leverage. China wants to be embedded in every major economy's supply chain so that access can be cut when those countries act against Chinese interests.
The consumer picture is where I found the most tension. Near term, the 30 to 45 cohort looks genuinely compelling. Long term, it's a structural contraction.
Yes, Maya. The long run trajectory is stark, only 8 million births annually against the 20 million needed to maintain population, with the total expected to shrink from 1.4 billion to around 1 billion over 30 years. That's a fundamental shift in market scale, but right now that 30 to 45 cohort is hard to match anywhere else. Real estate often already paid off, limited dependence, high discretionary income. Luxury has captured this. Jewelry and gold sales doubled. And in autos, two-thirds of new cars are priced below $25,000. So premium spend and mass market scale are coexisting, which explains David's customer lifetime value point. Securing a 30-year-old Chinese consumer with multi-decade purchasing potential is a very specific kind of opportunity.
A window that exists now but closes as the demographic math plays out.
And it's not homogeneous either. The real estate crisis complicates the picture significantly. Estimated at twice the scale of the 2007 US subprime crisis, 65 million vacant homes, real estate at 20% of GDP, with 70% of personal wealth tied to property. Even a partial correction hits household consumption hard. And unlike Western economies, where governments and financial institutions tend to absorb the shock, in China the adjustment falls on households directly. No significant social safety net. So you have this high discretionary cohort on one side and a much broader wealth erosion risk on the other. Retailers who approach China as a blanket growth market are going to miscalculate.
The channel question is interesting too. Live streaming in China isn't just a trend. And Cheetah, it sounds like it has become the infrastructure of commerce.
It really has, creator economics, social proof loops, impulse fulfillment. That's where a significant share of purchasing happens, especially for younger consumers. If you're not operating inside that infrastructure, you're not in the conversation. And David's point is that this matters beyond China. Demographic conditions producing this behavior, single child households, individualistic consumption, concentrated discretionary spend, are emerging across Western markets too as fertility rates decline. The live stream commerce model may reach your home market sooner than the timelines suggest.
The last thing I want to make sure we get to, because I think it surprised me most in the piece, is Chinese brands going global. BYD ahead of German automakers in brand strength, Huawei ahead of Apple in China. How durable is that?
David thinks the next wave of global consumer brands comes from China precisely because the economy of war model can subsidize exports and sustain innovation losses that Western firms, with very different investor expectations, simply couldn't absorb. You can run longer bets, accept near-term losses, prioritize strategic position over quarterly returns. That's a structural advantage. And on sustainability, he uses Shein as the interesting case. It's a global fast fashion leader built on a data-driven white label platform, low quality products right now. But the infrastructure and scaling capability are formidable. The question is whether that same platform could be redirected towards sustainable products at mass market volume. If it can, then cost, speed, and environmental responsibility stop being trade-offs, and whoever gets there first writes the terms of the next retail cycle.
And whoever does that first is no longer competing on your terms.
For a long time, yes, because once that becomes the standard, You're not competing on heritage or footprint anymore. You're competing on who industrialized sustainability first.
Anchita, this was a genuinely thought provoking conversation. For anyone who wants to go deeper, the full exclusive is in the episode description on our Substack at IADS Exclusive Insights. Thanks for joining me.
Thank you, Maya. Worth the conversation.
Thanks for listening to the IADS Retail Park. We'll catch you on the next episode. Please be advised that this podcast features AI cloned voices created with human oversight.